Welcome, class, to our discussion of itemized deductions from Chapter 5 and how those work on the tax return. So we have some PowerPoint slides to review. So we'll just review from Chapter 1. You pick either the greater of the total itemized deduction or the taxpayer's total standard deduction. Remember, that could include an additional standard deduction back in Chapter 1. But remember, it's one or the other, the greater of the two. So it's estimated that 70% of taxpayers do not itemize, meaning that their itemized deductions, at least from what they know about the law, they choose to use a standard deduction. So our itemized deductions include this list. We're going to talk about the first 5 in Chapter 5 and the last 2 in Chapter 6. So these chapters really do go together. All right, this is the Schedule A. This is where your itemized deductions are listed and calculated and totaled up. And we're going to show as we go down, we're actually going to discuss them in the order that they appear on the form. Now, this is the form as it was proposed at the end of 2017 before some last-minute changes to the tax law. So there are a couple of things that will be a little different from this. And you can see the headings making the Schedule A one of the easier forms, I would say, to use of the tax law because it has these nice headings to tell you where each of the parts are that you need to make your calculation. So first one as we go down the order is medical and dental expenses. Notice these are unreimbursed, meaning if your insurance pays for them, you don't get to utilize them. They also have to be for you or your dependents, although that situation, the dependent definition is a little broader than the normal dependent one. So, but you can't just pay for somebody's medical expenses off the street and that be deductible. So there's what is called a floor based on your AGI. And this is where the tax law changed right at the end of the year. And instead of being 10%, as it says on the form, and as it has been for a couple of years, it's back to 7.5%, which it was a few years ago. So that's what we will use, 7.5%. That's different than your textbook, which was not updated yet. Went to a publisher before the tax law was finalized. So these are the types of costs that are included in medical expenses. Transportation, meaning going to and from doctors, to and from hospitals, that sort of thing. Notice it's a 17 cents per mile. So different rates for different types of miles. Travel expenses per person per night. That's if somebody has to go with. So say a child is in the hospital and mom goes or dad goes to stay with them and stays in, there's no place in the hospital to stay, so they stay in a hotel. They can deduct up to $50 per night for that. Notice that all your medical equipment, health insurance premiums, this is nursing home care. They have to be a medical reason to be in the nursing home, not just assisted living because they need some help getting their shoes on or things like that. This has to be actual nursing home care. The idea here is prescription. There has to be a doctor prescription. If you buy it over the counter, it's not deductible. It's not part of the medical and dental expenses. So if you have a reimbursement, say for instance you deduct a cost and then your insurance reimburses you the next year, if it was actually a benefit, you're going to have income in the second year. So it's all reported here in the first section on line 1. And notice that you calculate first the floor, put your amount of expenses, then calculate the floor, and then you deduct the amount over. That's why it's called a floor. You're only worried about what's over that amount. All right, our next section is taxes. These are the taxes that can be deducted. Notice what's missing right off the bat is federal income tax. Remember, federal taxes are not deductible. The rest of these are. So several ways that people pay their state and local income taxes. Most of the time we think of it as being withheld from their checks on their W-2, but they also may make estimated payments or may pay some amount with their return when they send it in. So in this case, we have a situation where $6,060 was withheld. During 2007, we made some extra payments of income tax, and then we paid this in 17 when we filed our 2016 return. So the key is what date was it paid, not what time period is it applied to. So this is applied to the 2016 return, but was paid in 2017. So the total, it is included in our total deduction for 2017. Property taxes, this is unlimited. It can be on as many properties as you want, wherever they are located and so forth. So this is not limited to the United States even. And we're talking about real property here. And you have to watch, that could be a lot of different taxes. In Pennsylvania, you have your spring or school taxes. Your spring taxes, which are actually for the municipality, and the fall or school taxes. So you need to get both bills in there. These are based on ad valorem taxes, all right? And again, it's when you pay them, even if they are not due. Now this strategy here allows for some tax planning, but this is going to go away. The new tax law made these taxes limited in 2018, so bunching and going forward is not going to be very helpful. Personal property taxes, this is the key. They have to be based on the value. So we do not have a personal property tax in the state of Pennsylvania, but some states do on various types of property, usually vehicles, but also like motorhomes and recreational vehicles, motorcycles, that kind of thing. The tax has to be based on the value. I mean, it can't be that everybody pays the same amount. In Pennsylvania, we pay a license fee each year. It's not based on the amount of the value of the car. So someone with a $100,000 car pays the same as I do on my old Honda. So that's not an ad valorem tax, and therefore it's not included in this personal property tax. For income taxes, you can choose. Either use it as a credit, which is usually going to be a better deal, or you can deduct it as an itemized deduction. And then general sales taxes. If you pay sales taxes, see if folks in states that didn't have a state or local income tax were frustrated because those states often have a very high income sales tax, and they weren't getting any benefit from that. So the law changed a few years ago and allows that if your sales tax is more than your income taxes, then you can use that instead. So it's one or the other. You pick the best, the highest. There is a table to estimate your sales tax because nobody keeps all their receipts somewhere. And then you can look up on major purchases like cars or motorhomes what the sales tax you paid there and add it to the amount you estimate from the table. Based on the rate of tax in your state and your income, they kind of think, well, you're probably going to spend this much money. In Pennsylvania, this is almost always not the case. Unless you bought a really large asset that had sales tax, your state and local income taxes is going to be higher because our sales tax is, well, it's not that high in the rate, and it's also not on clothing or food, so it doesn't end up being that much in total. All right, here's the ones that are not deductible. Be careful of this. Okay, inheritance tax is not deductible, license fees, and if you pay taxes on for somebody else, you have to owe the taxes for it to be deductible. Just like we talked about before, tax refunds, if you got a benefit from it 1 year and get it back the next year, it's a taxable refund. So that's to the extent that they reduce their tax liability, you have to report it as income. All of that goes on Schedule A. Interest. This is pretty straightforward. Almost all home mortgage interest is deductible, but there are some important limitations. You get one main home and one second home. You can do it on what $1 million of acquisition debt. If your house costs $1.2 million, you borrow $1.2 million, you're not going to be able to deduct the interest on that extra $200,000. On top of the $1 million, or instead of, you can do it up to $100,000 on home equity debt, as long as you don't borrow more than your house is worth. So if acquisition debt, by the way, applies to money borrowed to buy or improve your home. If it isn't one of those two things, it's not acquisition debt, but it might still be home equity debt. So you start here because you got a lot bigger limit, and then you go to there. Points. Oh, just first of all, a couple of examples. In this case, we have 3 homes, but we only get the main home and 1 vacation home. We choose the highest of the 2 to get the greatest deduction. If we have paid off our main home and we're still paying on the vacation home, then we don't get a second vacation home. We only get the main home and 1 vacation home. Points are prepaid interest, usually to get a lower interest rate. Most of the time you have to deduct this over the life of the loan, but this very important exception, because this is where most people are going to incur points, is if you take out a loan, you pay points to improve, that loan is used to improve the main home, only the main home, not the vacation home, then you can deduct it full in the year paid. It'll actually show up on the paperwork from the lender as a deductible interest. So this is the example. The other 2 things that have to be in case, it has to be an established practice, and it is almost everywhere in the country, and you're not doing an extraordinary amount, more than most anybody else does, then you can deduct it all at once. And that's what this is, because he used the proceeds to improve his main home. Example 2, though, she used the mortgage to buy her vacation home. Therefore, the amount of the $2,000 in points is amortized over the life of her loan. Much less favorable outcome. Okay. Another example where he, on the main home, doesn't really matter the amount as long as it's not out of the ordinary. All right, and then he can deduct all of it on the year he paid it. Investment interest expense, the last part of interest is if you borrow money to buy investments. All right, notice that it has to be a taxable investment. If it's tax exempt, you don't get to deduct the interest. Cannot exceed how much money you made. So there will never be a loss, you might say. It's going to just cover the amount of interest you made. Unused amounts, though, can carry forward to future years. So $70,000, pays $5,000 on this loan, but only makes $4,500. So what does he get to do? He can deduct $4,500 on Schedule A. So notice he still has income that reports on Schedule B, interest, and then he has an itemized deduction of $4,500 on Schedule A with the other $500. So this is only going to benefit you if you have enough itemized deductions that your standard deduction isn't higher. So that still could end up not being a good thing, or not being a deduction because you don't itemize. Example 2, this case, we made $5,400 in interest paid that, and our income is $6,500, but we have some of it as taxable interest and some as qualified dividends. They have two options. You can deduct $2,500, just the amount of the taxable interest, and ignore the qualified dividends, or you can use the $2,900 of the qualified dividends as ordinary income, meaning we will not use the lower rate. Rest is taxable at reduced rate, and the $5,400 of interest can all be. So we treat the qualified dividends as interest. We don't get a lower tax rate, but then we get to deduct all of our investment interest. Last thing, actually missed the tax law. Mortgage insurance premiums. This is not homeowners insurance. This is mortgage insurance, meaning it pays off if you can't pay your loan off. They will pay it off for you if you go bankrupt or something like that. It's phased out the way that it's shown here, but it's listed as interest. On this form, on the form here, it's actually on this line called reserved, because when this form was created, that rule was going to be gone away, but then they retroactively in the tax law made it back to 2017.